Okay, tax students, this is your teacher Roy again, this time with a video lecture for chapter number 8, where we deal with the topic of depreciation. Quite detailed calculations here, but we'll see maybe the IRS has done most of the calculations for us. And then we'll have also calculating how much gain or loss we have to report when we sell those assets that were being depreciated. I think we'll have this lecture divided up into 3 parts. So this is part 1 of 3, where we're going to be covering depreciation probably through what we call personal tangible property. And we'll calculate out depreciation for real estate in a second video and summarize depreciation in that second video, including amortization. And then this last part here, the gain or loss when we dispose of those depreciable assets. So the term depreciation, maybe you've learned about this in a previous accounting class for financial reporting purposes and not tax depreciation that we're learning now here in our class. Depreciation is applied to assets we buy that's going to last us a long time. And we're going to allocate each year how much depreciation is going to be applied or deducted for that year. We're not going to depreciate any land costs. Yeah, land is not depreciated. But initially we have to determine how much of the cost will be depreciated. Here they call it original cost or unadjusted basis. And then any additional costs after that, let's say to maintain, to repair, to paint the property, to make it look good, to clean it, that can be deducted right away, those types of costs, the so-called maintenance and repair costs. But if you have additional costs to expand the asset, to make it bigger, to make it last longer than its original life, that additional cost may have to be set up as another asset depreciated over so many years. The IRS tries to make the depreciation calculation as objective as possible. In other words, we don't have to guess the number of years the asset's going to last. We don't have to estimate what's the salvage or residual value at the end of its life. Okay, but the calculations are still kind of complex, but hopefully the IRS has done most of the legwork for us. There's 3 types of depreciation calculation, or 3 types of depreciation we can deduct. What you're looking at here is the main one that has been used for many years, but maybe not applicable to many small businesses because the other 2 methods are going to eat up all of the cost before we get to this type of depreciation called Modified Accelerated Cost Recovery System, or the acronym is pronounced MACRS. And we're going to divide up our assets between real estate, real property, versus personal property. We know what real property is, real estate is, right? We're standing on real estate, the land, and anything attached to the land like a building, a parking lot, improvements is real property. So that means any other tangible stuff we can touch, property used in a business, is personal property. So let's learn about depreciating personal property here in this part 1 of our video lecture. There's many categories of personal property, but the main 2 types are called 3-year property, sorry, not 3-year, 5-year property, and 7-year property. 5-year, example of 5-year property are office equipment like computers, printers, monitors, or light-duty trucks and passenger automobiles, and certain other types of miscellaneous equipment. And then most other personal tangible business property we're going to depreciate are stuff like furniture and other equipment that's not office equipment. I mentioned 3-year here, now not popular because maybe an asset that falls into that category would be racehorses. I don't know about you, but I haven't had a client that has resources, yeah. But these two here are very common. Again, versus real estate or real property that we'll learn in part 2 of our video lecture. So in our textbook, we have a little bit more detailed of what goes into the, in this case, 5 and 7 year property. Again, all of those categories, types of assets we mentioned before, yeah? And the actual calculation uses a depreciation method called double or 200% declining balance. We don't need to know the actual calculation because, again, the IRS will simplify it for us just to one percentage amount each year. Again, we're going to see the real estate or real estate depreciated in part 2 of our video. So we'll focus on just personal, tangible, meaning you can physically touch it, property. Intangible, we'll cover that in part 2. So there's two broad categories now of personal, tangible property. One is called the half-year convention, and another is called mid-quarter convention. The word convention just means there may be a special calculation. In the first year, you place the asset into business use, and in its last year, that same asset in its last year of business use. Okay, that's what convention means. Yeah, convention. And then the detailed calculations, again, are built into a table. And we're going to assume under the half-year convention, which is the general rule, the default of the two conventions here. In the half-year convention, we're going to assume we're going to take a half year's worth of depreciation in the first year we use the asset in business, and then another half year in the last year you use it in your business. Okay, so that means if you have a 5 year property, if you take only half year in the first year, that means the 5 years is going to be really spread over 6 years, half in the first and half in the last, the 6th year. Same thing with a 7 year property, half in the first and half in the 8th year, totaling up to 7 years. So in our textbook, here in this table 8.2 is a half year convention table. Again, this is the default for most businesses, for most property placed into service. So we're going to be using these two columns here. So in the first year, you place into service a 5 year property. You're going to, here's the first year, you're going to take 20% of its costs and deduct it as depreciation. That same asset, now next year, in year 2, you're going to take 32%. Third year, 19.2%. And if you add up all of these percentages, it should come out to 100. Again, 1, 2, 3, 4, 5, 6 years spread over 5 years spread over a 6 year period. Yeah. Same thing with the 7 year, should total up to 100%. 7 years spread over 8 years. So you can see it starts off kind of big and then tapers down to a smaller percentage. That's what declining balance does, this method. In fact, over here, these 2 years, and in fact in the last year, this is really straight line method. This last year being half of the previous year straight line method. Likewise, you can see all the same straight line methods in the later years of the 7 year life. And again, half of that for the last year. But again, totaling up to 100, the whole thing, specifically over 5 or 7 years. Okay, and then again, no salvage value taken into account, even though the assets still may be there after 5 or 7 years. Makes it much more objective. So here is an example where a company bought furniture. We know that's 7 year property. So we take the costs in the first year and we multiply it by the percent you would see in the table. You take the same costs for the second year and you multiply it by the percentage you see for the second year for that table. So let's go back to the table. Again, furniture would be in this column. Here's the first year percentage and second year percentage. And you would keep on going for future years. In this second example too, we have office equipment. Yeah, that costs 12,000. So again, we take the cost, same cost, use every year, and this would be 5-year property. So again, we look at the 5-year column. Here's the percentage for the first year, percentage for the second year, and so forth. And you multiply it by the same cost, by those different percentages each year to get that year's worth of depreciation, each year's worth of depreciation. So it makes it much more objective. Find the class life, 507, find the percentage, and you multiply it by the cost, and that's your depreciation for the year. That's for personal property, not real estate. Now, the other convention, the other method of calculating depreciation in the first and last year is called mid-quarter versus the half year we just looked at. Again, half year is default. Half year is the automatic, unless you have to use this mid-quarter. And the mid-quarter convention has to be used if more than 40% of what you buy during the year for business, personal, tangible property is purchased in the last quarter, last 3 months of the year. Then instead of using half-year convention, you have to use the mid-quarter convention. Let's see if I can illustrate this here. So let's assume that this is a timeline for the year. So this is the end of the year, December 31st. And here's the beginning of the year, January 1st. So here's the first quarter, the second quarter, the third and fourth quarter. In the previous convention, half-year convention, no matter when you bought the asset during the year, you're assumed to have bought it right here in the middle of the year. So you would take depreciation from July 1st through the end of the year built into the calculation. But now, here in the fourth quarter, if you buy more than 40% of your property placed into service for personal property, then you got to use the mid-quarter convention, where you're going to assume anything bought in each of these four quarters is going to be placed into service right in that middle of the quarter and depreciated to the end of the year. In other words, here for this first quarter, again, if this rule applies here for the first quarter, anything bought from January through the end of March is assumed to have been bought right in the middle of that quarter. I think that's February 15th. And you're going to depreciate it to the end of the year for the first year. And then anything bought here in the second quarter, you assume it's bought in the middle of the quarter. Because I think it's May 15th. And you depreciate it to the end of the year. Likewise, third quarter to the end of the year. Fourth quarter, you just depreciate it for 1.5 months for that first year. But then the next year, you're going to depreciate it for the full year. And then in the last year, be it 5 or 7 year class life, you just depreciate it for the remaining few months you're going to own it to total up to 5 or 7 years. Okay, so instead of using the half-year convention, now you're using this table, table 4-8, and there's some rows missing, at least for the 7-year property. Really, even for 5 years, there should be a 6-year row here. Okay, so if I buy something here in the first, if this rule applies in the fourth quarter, then anything I buy here in the first quarter is going to use this rate here or here. Anything I buy in the second quarter is going to use this rate here or here. And then next year, I use the same class life and use the second row for this first quarter, this second row for the second quarter. Again, the thing that's triggering to use this table is that more than 40% was purchased in the fourth quarter. Let's see if we can take a look at that example here in the previous slide for the Chavez. They bought two assets. They bought two assets here. One in the first quarter, March 15 is the first quarter, 50,000, and one in the fourth quarter, 225. So if you total up the two here, it comes out to this 275. And if you divide the fourth quarter purchases by the total for the whole year, you can see it's more than 40%, more than 40% for the whole year. That means you gotta use the mid-quarter convention. That means you gotta use this table instead of the half-year convention table. That means that the, what's it now, 5-year property, you use this rate the first year. The 7-year property, you use this rate in the fourth quarter for the first year. And then next year, the 5-year property, you use this rate. The 7-year property, you use this rate, and so forth for future years. I think that's the solution here for this without showing you the actual dollar amount. Let's talk about bonus depreciation. Again, there's 3 categories of depreciation. The first one that you would apply that we'll still need to see is called Section 179 depreciation. This is an election. You choose to do it, otherwise you don't deduct anything. This bonus depreciation is the second one you look at. Bonus is typically automatic. You take it unless you elect out not to take it. Kind of the opposite of the 179. And then what we've been learning so far is the third type, is the MACRS depreciation. So our textbook is kind of doing things disjointed here. They really should have talked about 179 first, and now bonus here second, and then MACRS last. In fact, we still need to learn a little bit more detail about MACRS in our chapter 8. So the rule for bonus applies only to personal tangible property, not real estate. Here you can see that has to have a life of less than 20 years, and real estate is going to last longer than that. And in the year you place it into service, you get to deduct the whole thing. So that typically means there's nothing left over for the MACRS depreciation that we've been learning so far. And for most small businesses, they probably will deduct the whole thing for small items they buy, a computer, maybe even an automobile. Okay, and this bonus depreciation deduction can create what we call a loss for the business, a net operating loss that can be used to offset up to 80% of other income of the taxpayer. And if you still have excess net operating losses or NOLs, you can carry it over to next year to offset next year's depreciation up to 80% of next year's income. Okay, so 179, if you don't elect it, that leaves you to claim 100% of the bonus, and that leaves nothing now for the MACRS. There may be situations where you do want to claim 179 and elect out of bonus not to do this. And that means now you take MACRS depreciation on anything remaining that wasn't deducted on 179 in bonus. So let's see. Another example, we have Nicole buying a business desk and a chair. This is office furniture that has a class life of 7 years. We're told to use the half-year convention. That's the MACRS table. We're told to assume that there's no bonus and no 179 that we haven't talked about yet in our lecture. So we just take this amount and you multiply it by the rate. What was it, 14%? Here's the rate. Okay. Now, if you do take 179, you probably can deduct the whole thing, and we'll see limitations for 179 depreciation. If you do take bonus, you can probably deduct, like I mentioned before, 100%, keeping in mind the three different methods cannot total more than the costs. Here we didn't take 179, we didn't take bonus. So that leaves this cost now to be depreciated over the next 7 or 8 years, again, using the rates in that table. Okay, let's stop here and we'll come back with part 2, dealing with depreciation for real estate.